Welcome to The Explainer. Today, we're going to break down the core mechanics of how you can legally turn your everyday expenses into some pretty powerful tax deductions. We're going to start with the basics and work our way all the way up to some expert-level strategies, focusing on the rules that unlock serious savings. You know, for most of us who get a regular paycheck, the tax system can feel like a one-way street, right? Money comes in, taxes get taken out automatically, and that's kind of the end of the story. There's not much you can do. But for a business owner, it's a whole different ballgame. You have to see the tax code not just as a bunch of rules to follow, but as a playbook. It's actually designed with incentives to reward people who take risks, who create jobs, and who really fuel the economy. And it all starts right here. This single rule, Internal Revenue Code Section 162A, is the absolute bedrock of all business tax strategy. It says you can deduct expenses that are ordinary and necessary. Understanding what those two little words mean is the key that unlocks absolutely everything else we're going to talk about. Okay, so let's get into it. We're going to start with the most accessible strategies, the deductions you can start claiming for things you are probably already using every single day. Let's talk about the home office. If your home is your main place of business, you can actually turn a chunk of your housing costs into a business expense. But, and this is a big but, how you calculate this deduction makes a massive difference. You basically got two options. Okay, so let's break this down. On one hand, you have this simplified method, and it's exactly what it sounds like, simple. $5 per square foot with the cap of $1,500. It's easy for sure, but you're almost certainly leaving money on the table. Now, the actual expense method, that is where the real power is. You figure out the percentage of your home you use for business, and then you apply that percentage to your real costs. We're talking rent, mortgage interest, utilities, you name it. For most people, this results in a deduction that's 2, 3, even 4 times bigger. And you know what? The exact same logic applies to your car. If you're using your personal vehicle for business, driving to meet clients, picking up supplies, you can deduct those costs. And just like the home office, there's a simple way and a much more powerful way to do it. So the choice here really comes down to simplicity versus strategy. The standard mileage rate, super easy. You track your business miles, you multiply by the set rate, and you're done. But the actual expense method lets you add up the business portion of everything. Gas, insurance, repairs, and get this, even the wear and tear on your car, which is called depreciation. It's more work to track, yeah, but the payoff can be huge. And look, it doesn't just stop with your home and your car. That ordinary and necessary rule covers a ton of stuff. We're talking about half the cost of business meals, travel expenses like flights and hotels, fees you pay to your accountant or lawyer, all your advertising costs, software, office supplies. The list just goes on and on. The rule of thumb is if it helps you generate income, it's probably deductible. All right, so we've got the foundational deductions down. Now let's level up. We're moving beyond just tracking individual expenses to looking at the very structure of your business. This is where your legal framework itself can become one of your most powerful tax-saving tools. This is where real strategy kicks in. So the first move for any serious business is almost always forming an LLC or a limited liability company. Think of it like a firewall. It creates a legal shield that separates your personal assets, your home, your savings, from any business debts or lawsuits. It's crucial for protection. But here's what most people don't realize. An LLC by itself doesn't actually lower your self-employment taxes. For that, you need to take one more step. And this right here, this is the S corporation election. It's an absolute game changer. It's probably the most common strategy small businesses use to legally slash that hefty 15.3% self-employment tax. Here's how it works. You keep your LLC for that legal shield, but you tell the IRS, hey, I want you to tax me as an S corp. This lets you split your profit into 2 buckets, a reasonable salary you pay yourself and a profit distribution. And here's the magic. You only pay that big self-employment tax on the salary part. The rest comes to you tax-free from a self-employment standpoint. And the numbers on this slide really show you why this is so powerful. I mean, look at this example. On $100,000 of profit, just by structuring the payments this way, an entrepreneur can save thousands of dollars in self-employment tax. That's real money that goes right back into your pocket or back into growing the business year after year. All right, now we're climbing to the top of the pyramid. This is where we get into the really advanced stuff, mostly in real estate, that allows investors to generate massive paper losses that can actually be used to wipe out the tax bill on their other income. So, the main idea we need to understand here is depreciation. Basically, the IRS lets you take a tax deduction for the wear and tear on your investment property over 27 and a half years. So think of it like this. It's a pre-approved, guaranteed tax deduction you get every single year, even if your property is actually going up in value. But what if you could put that deduction on hyperspeed? Well, you can. It's called a cost segregation study. It's basically an engineering analysis that slices and dices your property. Instead of writing off the whole thing over 27 and a half years, it identifies all the bits and pieces like carpets, light fixtures, even landscaping that can be written off much, much faster, say over 5 or 7 years. This strategy front-loads your tax savings and creates huge paper losses right away. Now, here's the piece that makes this all click together. Normally, those big real estate losses are considered passive, which means they can only cancel out other passive income. But there's a specific loophole that completely changes the game. If you run your property as a short-term rental, where people stay for 7 days or less on average, and you are actively involved in managing it, those losses get reclassified from passive to active. So let's see how this all connects in a real-world expert-level example. Let's say your main income from your job or your primary business is $300,000 a year. That puts you in a pretty high tax bracket. Okay, so now you go out and buy an investment property and you run it as a short-term rental. You get a cost segregation study done, which turbocharges your depreciation, and it generates a massive $90,000 paper loss. And remember, you didn't actually lose 90 grand, it's just a loss for tax purposes. Because of that short-term rental loophole, your $90,000 loss is now active. So you can take that loss and use it to directly reduce your primary income. Just like that, your taxable income plummets from $300,000 down to $210,000. That translates into tens of thousands of dollars in tax savings all in 1 year. Okay, we've gone over a lot, from simple car deductions all the way up to complex real estate loopholes. But every single one of these strategies, from the absolute most basic to the most advanced, relies on one single non-negotiable principle, and that is documentation. Tax experts are crystal clear on this. Your record keeping is not optional, it is the entire foundation of your defense. Because in an audit, your word means absolutely nothing. If you don't have meticulous records, receipts, mileage logs, bank statements, that legitimate business expense is just a personal hobby. The proof is on you, and your records are your only army. So you see, the tax code isn't just a burden to be dealt with, it's a playbook, and it's full of rules and incentives. Understanding them doesn't just save you money today, it gives you the capital to reinvest, to grow, and to build a much more efficient financial future. So the real question is, now that you know the playbook, where are you going to start?